coming to you live with the world from here. And actually this morning, a little unique as well, because we're actually streaming this to the Asian Financial Forum in Hong Kong, where over 5,000 business leaders are assembled over the next few days. And welcome to those from around the world. And this morning, we're going to be talking about DeFi, decentralized finance, and what that means, why the growth has been so robust in that marketplace and with exchanges. And we're very fortunate to have with us an expert in that field. And I'm Daniele. I'm the Chief Marketing Officer of BlockCerts blockchain. And this morning we have with us Mr. Christof Waton, who is our DeFi and crypto expert, and he comes to us from Belgium. So good morning to you there, Christof. Good to have you.
Well, good evening here. Thank you, Dan.
Or evening to you.
Great.
Yeah, and then we all have, as always, with the world from here, Daniele Mensi, who's the president of FusionSTX. Good evening to you, Daniele.
Thank you, Dan. Good morning to you. Good evening to me, and always a pleasure to be here.
Awesome. And then we also have Mr. Tim Vasko, who's the CEO of BlockCerts blockchain, the chief architect and the founder. Boy, we've had some just incredible things happening here over the last few days, and very exciting times to see how blockchain is blossoming and really creating real world solutions and changes. So, Tim.
Yeah, over the last few hours, Dan.
That's what I mean.
It literally is changing hour by hour, and so this is an exciting world that we live in. I guess more than ever on every front, right? But this space of DeFi is really incredible, and I'm super excited to hear from guys who know what's going on because it's booming. So let's get into it. Let's dig in.
Let's get into it. So this is a Q&A, so I'll be checking for each of you. If you've got any questions, just post those in the stream, and we'll be taking those questions. We had quite a few questions from last week. We defined what DeFi is, but quite honestly, it's so new within the last year, and it's new to a lot of individuals. But it's one of those things that is catching hold, and it's growing. And from my understanding, it's about $17 to $20 billion marketplace right now, coming from zero just less than a year ago. So it's certainly in growth mode. And I would just put that out to you, Christof, if you could just kind of tell us in your words, what is DeFi, decentralized finance, and why do you see the growth in the DeFi market?
All right. So first of all, like you said, like DeFi the past year came up, and it was well needed, and it was just basically the next step for crypto and blockchain to make. What DeFi actually does is it kicks out the middleman. For me, like banking institutions, everything like that, most likely will go over towards crypto. There are many crypto banks appearing with lending backed by the collateral. So in terms of DeFi, it's mostly kicking out the middleman for me, and it rewards a lot. It's all about transparency, where, for example, a bank is always your middleman. You kick out the bank and you deal with people directly. In terms of commissions and middle step and transaction fees, mainly that's gone.
It's the bank and the investment banker, right? It's like the brokers, the agents, all the guys that have traditionally been facilitating trades. So maybe we can talk a little bit about what market making is, Chris, if you can maybe throw that in there.
Okay. Market making is basically, can be seen in 2 points. Market making for me is order book management, where the market maker gets collateral for both sides of the order book and just fills the order book. Then there's volume making, which for me is not market making. He fills the order books exactly like the market making, but he performs trades between multiple accounts at 0% trading fee commission.
Right.
So that's for me the difference between market making and volume making, basically.
But there's a spread too, right? There's always, like in traditional order books or traditional markets, no matter where you're at, there's a spread. That's how these brokers and Wall Street and everybody gets paid, right?
Yeah, correct.
And DeFi introduced, so for those, being familiar with the traditional exchanges and traditional order book management, so in fact, the decentralized exchange on DeFi introduced a new concept of market making, which is called AMM, automated market making, which changed the way exchanges work. There's no order book. So people trading onto an exchange, they see the order book, they see the bid and the ask side of the order book, they see the orders being filled, and they see the movements mostly generated by market maker, right? There are people placing orders, canceling orders, you see all those movements, right? In a decentralized exchange, this is wiped out. It doesn't work like this. You don't see those movements because there's no market maker. Everything is done. There is a market maker actually, but it's automated. The platform itself is the market maker. When Christof is saying the middlemen, the guys that today are doing market maker for the assets being traded to the exchange will no longer exist. Right. Because the platform itself is doing automatically this. For people in the traditional finance, it's difficult to understand because you replace a bunch of people doing this as a job with an automatic function of an exchange, which set the price and fill the orders automatically and adjust the price over time. And eventually, obviously, there might be arbitrage opportunities. There might be some price difference and arbitrage, but at the end of the day, the system itself will automatically correct over time this price. It's amazing when you stop looking at it, the way it works. I mean, I'm amazed by this.
Well, it's pretty interesting because I remember back in the day, which dates me, when HFT, high frequency trading and automated trading first came out. And in 1987, that actually crashed the traditional markets. It was the first big, modern era market crash in the United States. So when these kinds of tools came out initially, the markets weren't prepared for handling that. Then, here we are a couple decades and a bit later, and we're sitting here looking at how these global markets are shaping up with technology taking the place of all of this traditionally manual process that paid literally trillions of dollars in fees or pays trillions of dollars in fees throughout the world. So it makes a huge amount of sense, but let's talk a little bit about, okay, so this exists, it's new, it's fresh, it's based on blockchain, obviously, and tokenomics and all of these kinds of things. Let's talk about what it means in real terms, because I've been digging through this for the last few months, and it's pretty geeky still. It's still pretty much the domain of technical geeks and financial geeks coming together. So let's try and bring it down to earth here a little bit for the average person who understands traditional markets and might want to get up to speed on and get involved in what this means to provide liquidity, for example.
Well, and before we answer that, Tim, to this, I see this as deja vu, almost like the internet. We were talking the other day about how the internet was developed as a scientific platform that geeky scientists, et cetera, were using, and then it started to go mainstream, and it changed the way that businesses were created out of it, Google, et cetera. So I just see this as a huge deja vu with what is happening. So if you could answer that question, that'd be great.
I actually
Yeah.
I actually disagree a little bit with Tim when he says technical geeks and financial geeks, because if we explain it to just normal people, it's like they have their money stored at a bank. Let's say you have 50,000 at a bank. Okay, I challenge you, go right here, right now to an ATM, withdraw your 50,000. Your money is not your money. What does the bank do with your money? They lend it out to other people at 5%, 6%, 7%, whatever percent a year. How much percentage do you get on your money at that bank? 0.1 maybe. I mean, here in Europe it sucks anyway, but That's
You know-
basically
you know,
taking
if
out
all the
middleman.
people in the world-
This is what blockchain stands for. Your money is your money. Whatever happens with your money, you put your money there. You approve it.
So the margin is actually what in the crypto world or the DeFi world is called rewards, right?
yes.
So the bank, like all of these banking businesses of in any nature, it could be mortgage banking, it could be investment banking, it could be banking.
They're all crooks. They steal from the people.
Well, okay.
Yeah, you know what I've done? My
Looking
daughter,
like a true DeFi guy, Chris.
but I can
Yeah,
tell you,
I mean,
But it's really the flow of money, which isn't the flow of your money. Well, it's the flow of your money, but you get no benefit from
Don't
it.
be
the
so
second
gentle.
that you deposit your
so
money at the bank, it's not your money anymore.
Yeah.
you know how much time it takes if all of us, okay, today go into the bank and ask for our money at the same time. The
I got
word,
all my money in crypto. They wouldn't
yeah,
make a
yeah.
problem.
But let's say
make a
if we go
problem
to
of
the
it.
bank, if we go to the bank today, not only the bank doesn't have the money, obviously, but the government didn't print that money to be withdrawn at the same time. It will take 12 years of print. There's no printing actually, because the money is digital. By the way, to withdraw this, so it's even beyond the bank, the way it works. It's
So-
not only at the bank level,
Here's-
it's a systemic.
Here's actually how it's actually also converted to crypto these days, because you talk about banks, and banks is a centralized institution. It's that simple. So centralized exchanges before DeFi, okay, what a centralized exchange is you have the exchange, which is just a virtual representation of what's supposed to be in the wallet. The second that you deposit your funds in the wallet, they do with it whatever they want, because all what matters is the deposit and the withdrawal. So if everyone in the crypto right now would withdraw their money from a centralized exchange where, like I say, the second you deposit, it's not yours, the liquidity is not there anymore. The money is not there anymore. It's used, it's being gambled, it's being put with centralized exchanges. Like the top 4 centralized exchanges, they have a liquidity pool on their own.
Right.
So I mean, it's the same system.
So in reality, the way that this, and Dan brought it up earlier, and the reason I say it's the domain of technical and financial geeks is a lot of us who have spent our lives in this industry understand how all these business models work, because it basically boils down to a business model, right?
Yeah.
It boils down to what the return on investment is and who gets it. Really, who gets the return on investment? That's what we're talking about. At some point, I think actually Bill Gates said this a few decades ago. He said, banking is critical, banks are not. So that was said 25 years ago.
Yeah.
And when I look at this, I think about something as clear to the rest of the world as airline and travel industry. When search engines first came out and you could buy your tickets online, that turned into one of the biggest bidding markets. In fact, when air travel was happening pre-COVID, I don't know if you knew, but there were more transaction and pricing changes in airlines than there were on the stock market.
Okay.
So the engine behind that was massive. The second big engine that came out that enabled this was built around this idea of moving ads from newspapers and magazines online. And this little company called Google, I don't know if you guys have ever heard of it, actually built their entire empire based on an algorithm that plays ads today called AdWords. We were one of the first beta testers of AdWords back in 2001.
Okay.
So that was a trading engine for ads. Now there are really sophisticated engines out there called RTB, real-time bidding, that in less than 1/100th of a millisecond will place those ads. The fee goes to those providing the engine. So that's like high-frequency trading for ad space. Right? That's how that works. All those ads going across YouTube and everything that clicks on here. As our channel grows, Google makes money. we get a few million people on here, we'll make some money out of that, and we'll make a penny, and Google will make $1, right? That's how it works. That's the spread. So talk about that, Chris. That's really those kinds of spreads that are the evolution or, facilitating the DeFi market, aren't they?
In terms of the spreads, what determines that the spread would be low on decentralized exchanges is that the liquidity is there.
Right.
What you need to know is not centralized, so it's up to the people to provide the liquidity. You provide the liquidity, you get rewarded. It's that simple. What you need, it's like a Forex exchange. Let's say it like that, and you want to trade euro to dollar, to make it simple. On the exchange, the order books are filled. You see order books, but imagine there's nobody, because the Forex itself, it would have order books preset because the Forex has liquidity for it.
Right.
On the decentralized exchange, it's up to the people to provide the liquidity. The liquidity you can provide, as an example, 50 euro or 50 euro worth and 50 euro worth of dollar, because you fill up the order book from both sides, the buying and the selling. But it's the platform itself that does it for you. The thing is that every trade that's being made by other people from euro to dollar, they would use the liquidity pool. Every trade comes along with, on Uniswap, for example, 0.3%. So those 0.3% would go to the people who provide liquidity to the order book. Right. Let's say, as a simple example, the order book, the liquidity pool has a value of 100 euros and 100 euros worth of dollar. And you yourself have put in, like, let's say 5. Then you have 5% of the 0.3% what uses the liquidity pool.
Right. So you're a pro rata share of the
you
fee.
get a dividend of the transaction fee, what's being used on the platform for providing liquidity.
Right.
So the only difference, instead of making a deposit in a bank, you're making a deposit into the DeFi network, the exchange, through a token. And by having that deposit there, you're getting rewarded, correct? Or how? I'm trying to make it.
That's more something like Nexo or Celsius. It's where you make a deposit and you get a reward based on what you deposited. Yeah. With decentralized exchanges and liquidity pools, it's that you deposit not at the platform itself. So you need to deposit both sides of the order book. So it always goes in a trading pair. Let's say euro dollar or dollar Canadian dollar or whatever what. So it's basically only trading. It's not a bank itself, what we're talking about right now.
No, I'm just trying to kind of draw some parallels, you know.
Yeah, and it's self-custodial. So this means the funds are yours. That was the point that Chris made before. So in fact, you come and you provide liquidity. So you have the funds in your wallet, let's say MetaMask wallet, or in the BCERT wallet soon.
Right.
And then you want to participate to that liquidity pool. So you take your tokens from your wallet, you move to that liquidity pool, then you just wait in the reward, which is proportional to the amount of the liquidity share that you have. And the rewards that you receive is a fraction of the trading revenues that pool generates. It's very beautiful, the model, and it's very powerful. What is interesting is that for the first time, decentralized exchange introduced the ratio 50-50 once a liquidity pool is created. So this means there have to be an equivalent amount of value of both, in this case, token or assets. Let's say in the example of Chris, where US dollar and Canadian dollars, or in our case, could be, for example, BCERT and Ethereum is just an example. So in that case, once you participate to the liquidity pool with your asset, you have to provide both to receive the reward of the trading generated by that trading pair. And the reward is 0.3% of the trading fees, which is split by the percentage of the pool that you own. The model is super powerful.
I can make it very easy. I can just quickly share my screen. I mean, I have a liquidity pool on Uniswap. It's very clear.
Great.
If you want, let's see. Share screen. Allow. Let's see. So this is Uniswap. This is decentralized exchange. So it's very easy. You connect to your wallet. Then you select like which token. For me, it's Ethereum UDO. Hyper problem. Well, UDO is not in import. So I have a balance here in Ethereum and I have a balance here in UDO. Okay. So what I could do is, let's say, so here you can see the price impact. If I would buy right now for 1 Ethereum worth of UDOs, the price impact would be 1.53%.
Of the liquidity pool.
That's yes.
I know the price impact.
When we look at the liquidity pool itself, this is the total value. What's in the liquidity pool right now? 147,000, of which this one is mine and this one is mine. So when I look at my own liquidity pool of it, sometimes the loading takes a second. So here's what I threw in. In total, I threw in the liquidity pool 74,481. And this is what I got as fees, just as for people using that liquidity pool.
You're being rewarded.
That's the reward. Yeah, exactly. So, I mean, of every transaction of people selling UDO for Ethereum or buying UDO with Ethereum, it goes through a liquidity pool. 0% trading fee on it, but that 0% is being paid to the people that provide the liquidity, of which I own 51% or something of the whole pool. So that's how you make money. The more money that you can make with it is, for example, you throw in the UDO and the Ethereum, and UDO, the token, would go up in value, and Ethereum goes up in value. That means that your funds go up in value a lot. And when tokens or the price goes up or down, I'll buy a lot, because in crypto, there's a lot of volatility. Everybody knows that. But volatility also means volume. Volume means buying, selling, means transaction fees. Right. It's still good in a way of where the crypto market would fall. Yes, but then the crypto market would fall anyway. So in a good way is when it gains, it's like your token gains, Ethereum gains. So both parts of your liquidity that you provided, you gain a lot of money on it, the gains of the token value, plus the transaction fees on the volume it generates.
Yeah. So can you explain impermanent loss?
Yeah.
Excuse
you
me?
Want me to explain? I can explain impermanent loss.
Impermanent loss, because it's important to understand the transaction volatility and how that balances out, and the value of the underlying asset is sometimes there, it's sometimes not, but the fee is always the same.
The point is that people, I mean, depends. So to explain the impermanent loss, the example of Chris, let's say you supply liquidity on 2 tokens, let's say Ethereum and UDO, the example of Chris. And then let's suppose the price of Ethereum change because it's very volatile and it drops by 20%. While you participate to the liquidity. So if at the time the price goes down and you want to withdraw, you want to get out from your liquidity, then you're losing money. So you have an impermanent loss. It's not permanent, it's impermanent, because the price might goes up. So you just have to wait. So if you wait and the price recover, then you don't lose money, you gain money actually, okay? So it depends what is the time perspective at which you isolate how much you have out of the liquidity, depending on the price of that token. So impermanent, it means that if you keep the token pool for a period of time, well, the token over the long period doesn't dramatically go down, you don't lose the token value of the pools, plus you earn the fees on top.
That's right. So what's interesting to me now, and we talked about the rewards, so that's just one level of fees. But as we've been working on with BlockCerts and so forth, this idea of adding rewards in there from utility, for example. So let's talk about liquidity pool tokens, where now all of this has been based on, so far, in the DeFi space, has been based on trading, speculation, right? But when you create an additional revenue stream, and let's say there's liquidity provided to create that revenue stream, you get an additional reward on top of those fees. Or what I used as an example last week is loyalty points or dividends or whatever, things like that are moved in there in the form of liquidity pool tokens. Maybe talk about that and explain how APY, annual percentage yield, and the model goes up when you're participating with liquidity that has additional rewards. And that kind of gets us into this concept of farming and staking and things like that.
Okay, so with staking, it's basically very easy to explain. It's where I'm going to give an easy example. Let's say 1 Bitcoin. Bitcoin is not to be staked, like, don't forget me wrong. Like, let's say to 32 Ethereum to be politically correct, because that is Ethereum 2.0.
Yeah.
So what staking does is for providing transactions, either way, when to get on the blockchain, to get registered, it requires mining or it requires staking. Proof of work, proof of stake. With proof of stake, basically, there are through oracles, to say it like that. It's confirmed that the money is there and the money can go like fluently like that. That's in a very, very simple way explained. Staking basically gives you a fixed reward normally on some platforms, and other platforms, and this is where people need to be careful about, they say up to. Up to is very smart, because up to 6% is like when you get 0.5%, I mean, it's up to 6. So what people need to understand is, like, sometimes it really is too good to be true when they give like 20, 30%. That's too much, because it would affect the market too much. With staking, there are multiple rewards in terms of time. Some platforms pay out like every 24 hours, the staking reward, but the staking amount initially stays locked. With DeFi as well, here's where DeFi improves all of that. With DeFi, it's not locked. You put your staking reward in whatever what, it's just not compounding.
Right.
So coming to farming pools is basically when you provide liquidity. Those liquidity that you provide based on a dividend is your liquidity points, to say it like that. Liquidity points mean you get a dividend of the transaction fees, what people use on the pair where you provide the liquidity for. With farming, it's different, because with liquidity points, providing the liquidity, your reward depends on the volume, what the pair makes, the trading pair makes. With farming, it's different. You give up on the risk of having no volume on the trading pair, but you can lock it in a time permanent contract. Let's say, for example, you can lock your liquidity points. That means for 30 days, because that is locked. You will not be able, you will not get the dividend of the transaction fees for the trading pair. But the reward, what you get is like a fixed amount, a dividend of the fixed amount, because like in farming, there's a pool as well. So that's based on the dividend as well.
And this is what we explained. I think we explained, I think we talked a bit in either last week and in a couple of other sessions with the people that are in the stakeholders of BlockCerts. So we explained the concept of participating to the BCERT, let's say, ecosystem, where obviously everything it's anchored to the platform business and to the utility business that Tim just mentioned before. So in fact, introducing DeFi is just creating an opportunity for, number one, unlocking liquidity opportunities out of trading volumes. But even if, and that's the beauty, because that's something that in centralized exchanges does not exist, actually. So this means even if, let's say, a business that start to be market maked in a decentralized exchange is not expected to have trillions of dollars as of day one, okay? So the volumes will grow by the time the business will grow and the utility of the platform will grow. So people participating to the liquidity have a second opportunity, which is the farming, what Chris just explained, to say, okay, I expect the volumes, trading volumes will not be so high at the beginning. So what I'm doing is I will somehow sacrifice, in brackets, let's say, my 0.3% of the trading fees, because I don't expect to have huge revenues at the beginning, and I will use, that's my daughter, I will use this token into the farming pool that will be linked by, for example, in our case, a utility business, a network business, whatever the network is. That's a concept which is so powerful in our ecosystem.
So in other words, where we say at BlockCerts all the time and the BCERT app store, all the middlemen that are getting all the fees are the software providers and the guys generating all of that. We're basically saying those fees go back into the network, and the network is rewarded for helping the users of that system grow their use of the system. So
Correct.
in a similar way, you're providing the growth of the network, and you're getting rewarded for that growth from those utility revenues. So again, to that, and the interesting thing to me about DeFi as it affects utility and technology is we've got trillions and trillions of dollars. I think we saw about $3 trillion created during COVID in the technology space, 3.1 trillion. Think about that. And that was all through fees. 100% of the software market is driven by fees. Let's first understand that. 100% is driven by fees. 100% of the banking industry is driven by fees. So who gets the fees? That's really what we're talking about when it boils down to all of this DeFi stuff, is how do you're not really disrupting the financial or economics models. You're not really transforming that. You're transforming the fee model. Let's just call it what it is.
Yeah, it's participation.
Nobody's trying to get away from regulation and safety and security and compliance and things like that. What we're trying to do is take that giant sector of fees and roll it back into the economy. That's the way I see it. That's what decentralization does. And we've carried this heavy burden and layer of fee-based businesses to do these transactions for centuries now.
Yep.
And it's time for a change, right? It's time to say, okay, well, now computers can do that better. And frankly, they're more honest, and they're not going to trade like fake mortgages and crash the economy. Coding needs to be audited. So we do audited smart contracts and things like that. And we put it out in the marketplace, and market factors bear that balancing act instead of market makers, and data protections and software use is borne by the actual companies creating the value. So that's what it means by taking the people who create the value in these technologies and return the value or part of that value back to them through the network, right?
That's right.
Percentage at which they play. The percentage at which you play is your stake, your percentage that you own. That's your stake. So as I was going through all this, I was making a relationship to words, because this gets back to my geek thing, Chris. The crypto and digital finance market has a great way of coming up with really interesting terms, but they can be translated.
Yeah, you just need to understand what it is to translate it into like normal terms. Like
in crypto, what I just explained later, it's called liquidity mining.
Right.
It's something that does not exist in traditional finance. It exists only in crypto. What is liquidity mining? Is this one.
And in the co-op world, like REI, where you get a co-op percentage back at the end of the year, or American Express, where you get Amex points, it's very similar to that too. If you have tokens and you're participating, you're going to get rewards back.
Well, at the end of the day, those are tokens, Dan.
Right.
Like, that's a token. Anytime I get a reward, that is the equivalent of a liquidity pool token, a reward token. It's the exact same thing. It's just, what can I do with it? What partners can I use with it? If I need use of software, I can exchange that back and use the software, right? If I don't need to use it all, I got a balance. and maybe I can do something else because maybe I can go get an airline flight with it, or maybe I can trade it for some cash or whatever. That's the idea that becomes very powerful here when we start looking at combining actual utility, like the things you can do and need to do, like this video we're doing right now, with actual liquidity, the ability to have the capital up front to pay for all those servers and everything, and then return the reward back. That's what liquidity in a business means in business terms, right?
Right.
So when we look at this, it's a complete shift of business model. This is a true digital business model. We talk about digital business models, but what we're actually doing is seeing them and creating them as they evolve between the function and the float of all of those tools, all of those things that have been traditionally controlled by organizations like venture capitalists. They have a pool of liquidity, right? That's what a venture capital pool is. It's a bunch of liquidity, and they give it to a business they think is going to do well. And then they leverage that up. Ideally, take it out to the public market, which does more, creates more liquidity, right? By doing this in a DeFi basis, you remove all those barriers to entry that have traditionally been to the benefit of a very, very small, technically a very small group of people or organizations. And can we do that with security, compliance, and regulatory authority? So I'm just going to take and put a plug in here for the Digital Financial Services Observatory, the DFSO at a Columbia Business School backed by the Gates Foundation since 2015. Actually, I found out yesterday when we did our Asian FinTech call there that it's been 10 years these guys have been looking at this.
Yeah, so it's ready to go.
Yeah, so a decade worth of work at looking at how this would evolve. This was thought about literally over a decade ago. I know we were thinking about it at BlockCerts over a decade ago, and how to build this out. But it's amazing to see guys like Chris and Daniele who are actually doing this now. And what I'm excited about is bringing that the two pieces together: the true function of business, along with this idea of how business meets liquidity. That's fascinating and important, and it's happening right now. It is.
And we've got a question from Michael on YouTube, which I'm glad to answer, which is saying, in practical terms, if I have BCERT token without knowing anything about DeFi, what can I do? Okay, or right. what are you talking about? You know, with relationship with DeFi and whatever. Well, and essentially, yeah. Sorry.
Go ahead. You answer, and I'll answer it.
It's a very simple. Number one, you can use software, because the main use case it's to use the token to consume software and to break the rules that we explained many times to our webinars. That's the use case number one. That is the main one, actually. Number two, you can swap this token, and once you swap it, you can do, number one, participate to liquidity pool, and then earn fees out of the trading that generate into that liquidity pool, number one. Or you can, let's say, you can participate to a farming pool. So this means you will no longer earn those trading fees, but you will earn American Express points, as Tim just explained. And the American Express points are linked to the utility business we're doing in a form of reward. Those are the three, yeah.
Let me take your explanation and put it in terms of utility, okay? You can use software, and as I always say to people, I'm going to give you two choices, and you can only choose one to run a business today: money or technology. You can't have both. Can you run a valid business today?
No.
You cannot.
Money or technology. That means, I mean, no technology or no money. Eliminate one. That means no mobile device, no cheating here, right? you need both, right? That's where our society has come to.
Well, money can buy anything. So, I mean, if you have enough money, you can buy it, right?
But if you can't buy technology, if you could use your money for absolutely everything but technology, how far could you go in business today?
You can always go shoveling, you know?
That's what I mean. You're going to be
mining. You can go mining, like physical labor mining.
Yeah.
You don't need technology for that.
And let's say you got a bunch of gold, but you couldn't use any technology to let somebody know that you had it. You're back to...
That's fine. I mean, you can walk around. I mean,
you can walk around. We're back to...
I can ask a turtle to like bring it across seas or something like that.
Right.
It's okay.
So when we start using software, the interesting thing, and this comes from one of your stats, Dan, which is software is only used... we pay 100% of a month for a seat fee, but we only use it 25% of the time. Right. Even if we're up all the time like I am, I seriously doubt that I use most of my software, much more than 30%, because so I've got 70% of it sitting there unused. When I'm on my mobile device, this is on right now. Here's a perfect example. This is on right now. And it's got storage that's being unused. This was very early blockchain technology, by the way, very early ideas in blockchain. Why can't I use this as a miner? Why can't I use this as a storage device to store? I got a bunch of storage on here. It's a big, big iPhone. I got tons of storage on here. Do I need to store on a centralized server? This is connected to the internet right now, right? So we have assets that we're paying for that we're not fully utilizing, if that makes sense.
Yeah.
When we have if we tokenize that utility, we can actually measure the amount you're using. And because we can now you own that because you paid for it, you've got excess capacity, you can put that excess capacity into the market, and maybe somebody else doesn't want to use all of that. They only need 10%. They can come get a portion from you, and you get rewarded for it. That's the big shift. That's the massive shift that's never been possible to do before we had blockchain technology in the first place. And here's why. Because if I want to give you my access to one of my utility devices right now, I have to give you my username and login, and you get access to all my data too. Right. It's combined. When we tokenize it, we can take that portion that I'm not using. I don't have to give you my username and password. You can just use my platform. That is the absolute worst thing that could happen to a business that is centralized and is making all of their money on the 70% that's not being used.
Yeah,
absolutely devastating to them. It's so there's no incentive for existing business models to do this, none whatsoever. If you don't have a big network of users, however, already, and you can build your business model around what's actually being used and rewarding those users by giving them access to put that excess capacity in the market and let other users come on board for much less money, now all of a sudden you have a more efficient economy for access to two things.
Yeah.
Technology and money. Whether it's money going out for the cost to use that utility, or it's money coming back in to reward somebody for lowering the cost. You now created a decentralized auction model for what's the value of the utility to do a video call, to do storage, to do things like that. That's what Dapps are about. It becomes incredibly, the problem with blockchain technologies is they all talk about Dapps. Very, very, very few have ever put it into real world terms where anybody that's an average user like actually use that technology. And it's extremely difficult to do that. That's what we've been working on with BlockCerts. That's the BCERT Dapps store. So you have all these interesting models out there now. Like, I can give my loyalty points, if you will, to one of my family members, or to you, Dan. I can give it to you and say, here you go. I got some extra. I'm not using it right now. We're friends. Go nuts. Or you know what, Dan? If you go in the market right now and it's $3 to go use this, I'll tell you what, I could use a little extra cash. You can use mine for $1.
Right.
That's what DeFi allows us to do. That's what moving things out allows us to do. And eventually at scale, the market levels that out, right?
It's an exchange.
It's an exchange.
Yeah.
It's an exchange of moving technical power out there. And for that exchange, it's a reward. Right? This is exactly the same as what happened with cab rides. This is Uber.
Yeah.
Yeah. And
Although you could decentralize Uber now too.
yeah.
We won't go there.
Well, I had another question that came in from Alan, and we've got to wrap this up here. And I think this is a good one. I think we've answered this question in a number of ways, but how long can this exponential growth rate continue and be sustained, like on Uniswap and on DeFi exchanges? And Tim, you answered that with just the $3 trillion in the market in terms of technology. But we were also talking today just about what's happening with centralized exchanges. And so, in my opinion, I mean, there's a lack of.
In 2019, NASDAQ made a statement that was with blockchain. They weren't talking about DeFi, but they said with blockchain and new market models emerging. So remember, this was a couple years ago now.
Right.
New market models emerging, which means we don't know what the hell the new market models are going to be.
Yeah, because DeFi today, it's captured mostly by the lending market and some leading providers in the lending space. They're also providing borrowing service, and some of them are providing, in the traditional definition, over collateralized lending. So. And we cannot predict in which direction, because many people are saying DeFi, it's bad. So there are some actors that are trying to get the most out of it, but there are untapped opportunities that we want to tap. So how can we predict the future? What we wanted to know here is just take the most out of it and introduce a layer of compliance, which today is inexisting, into the space.
And as far as scale, there are approximately, back to the NASDAQ thing, about 2.5 billion disenfranchised people who can't even participate in the financial markets.
Yeah.
So how long can scale occur here? This is the entire crypto market is what? Worth how many trillion, Chris, right now?
1 trillion, I guess.
More than one.
Yeah, market went up again, so it's like 1.
And I may be wrong, but I believe somewhere in the neighborhood of 35 trillion a day changes hands. 40 trillion a day. We haven't even begun, Dan, to answer the question. So we haven't even begun. We don't know. It's
blockchain was always supposed to be like transparency, but also banking for the unbanked. Because all it takes to have like your bank on blockchain, it's a smartphone. You don't need a centralized bank anymore. Because a lot of people like let's say Southeast Asia, a lot of people have no bank. They have a smartphone and they have crypto.
That's right.
They have that bank in their reach.
This is a bank.
Yeah, exactly. That's the bank.
If we provide the utility, it's a bank. If we provide two things, technology and liquidity or money, bank.
Yeah.
All of a sudden, it's very easy to understand that the scale and scope of what's happening today hasn't even begun to hit scale. It hasn't even.
I think it did begin because like of the news coming out of institutions hedging to Bitcoin, the investors, big banks. So in terms of that, I do think that where we went 3 years ago, what caused the market to collapse, is that they were all against it. They were all against it. Let's say 3 years ago, they came in the news, they were all against it. It was not happening. what actually happened is they manipulate the price down to jump in themselves on a very cheaper price, and only now they're coming forward saying,
Right.
"Oh yeah, crypto is good."
We saw that.
It is starting. It has
happen.
started. Like Miami, the city treasury of Miami was looking to put 1% into Bitcoin.
Yeah.
So I mean, also the news of Ethereum, like we have Bitcoin on CME, we have it already. Ethereum is joining Bitcoin on the 7th of February. The news is official. It got approved today.
Right. So overall, we have a new structure and a new system. We're out of time, but we have defined a new business model. At BlockCerts, we've defined a new business model of bringing into the DeFi space utility and functionality that combines technology and the money side of that, which is massive. Technology doesn't work without money. License fees are paid for. Everybody pays them. Everybody does. So the reality of where the world is today, where the world is going from here, and how we've seen it evolve, especially with COVID and the things that have brought COVID forward, is this awareness that this is needed. As Chris points out, Visa, every large institution has some initiative in this and actual operations. So as we start distributing that at scale, the upside of how many people are involved in this market is going to be massive. Absolutely massive.
I want to close with one note now that you mentioned Visa, with the crypto visas that you have, the crypto Visa debit cards. It's still
Right.
Visa though. You get a cashback.
Yes.
Like up to 8%. So, I mean, on any transaction that you make, like instant cashback, 8%. So do that with Visa.
And the reason you can do that, again, is because you can incentivize through these liquidity pools and through these reward mechanisms for fees that are already built into the system.
Exactly.
They're already built. They're there. These are costs that are already being paid. So it's a redistribution of that fee-based economy.
Yeah.
So with that, I think we're done. But Chris and Daniele, this was an amazing bit of information for our community at BlockCerts, and we really appreciate you guys adding that into taking this. We want to carry this forward. I know we're going to get. I'm just watching the streams of questions and things like that. It's just unending, but we do have to end. So with that, again, we're at the Asian FinTech Festival in Hong Kong right now, streaming live. And we are there all week next week. We're super excited about what's happening all over in the world with the possibilities. And we just, along with that at BlockCerts, always say, stay safe, stay healthy, and get digital with DeFi, decentralized finance. It's a big term that everybody needs to know about for the future.
Great. Thanks, gentlemen, for joining us, and everyone across the world. We appreciate Belgium, from Rome, from Nigeria, Brussels, Mauritius, India, all over the place. We're global. Yeah, we're global, and we appreciate everyone for joining us on these important Fridays. Thank you.
Thank you.
Thank you.